Hey everyone, and welcome back to Money Journey. Let's be honest, this past week has been rough. Watching your portfolio drop, especially as quick as it did after those tariff announcements, is tough. It's unsettling, it creates anxiety, and frankly, it just doesn't feel good. If you are feeling that pressure, you are not alone. It's incredibly difficult for investors, even experienced ones, to watch stocks go down day after day. But today, I want to talk about why sticking to your plan during times like this is often the most crucial thing you can do for your long term wealth. We are going to dive into the psychology of market crashes, why history suggests patience pays off, and how to view this volatility not just as a threat but potentially as an opportunity. Our natural human instinct, when faced with perceived danger or loss, is to flee. When the market drops hard, that instinct screams, sell, get out before it goes lower. It feels like the safe thing to do, the logical thing to protect what's left. But in investing, acting on that gut feeling is often exactly the wrong move. This emotional reaction, selling low during panic, it's precisely why many investors unfortunately lose money in the stock market over the long run. They buy when things feel good and everyone is optimistic, often near the highs, and they sell when things look scary and uncertain, often near the lows. Holding stocks when they are plummeting requires emotional resilience. It requires stomach, as they say. You have to fight that urge to cut and run. Why? Because historically markets recover, and selling at the bottom means locking in your losses and missing the eventually rebound. So, if selling is often wrong, what's the alternative? For long-term investors, it's usually holding firm, assuming the reasons you bought the companies in the first place haven't fundamentally changed forever because of this event. And for those with cash on the sidelines, times like this can actually present opportunities. Think about it. When price falls significantly, the risk associated with buying those same shares can actually be lower from a valuation perspective. You are getting potentially the same future earning stream for a cheaper price. Valuations across the board have come down because of this correction. If you go shopping and goods are at a discount, what do you think? Great opportunity to buy. In the stock market, it's the same. While nobody knows the exact bottom, studies have shown that investors who deploy capital during periods of extreme fear, say when the big spikes above 40 or when the market is down 20% or more, tend to have a higher probability of achieving better long-term results. This brings us to that famous quote from Warren Buffett: be fearful when others are greedy and greedy when others are fearful. Right now, there is a lot of fear out there. This is the time to at least consider being strategically greedy, not recklessly, but by looking for quality business whose price has been unfairly punished. Now, let me be crystal clear. I don't have a crystal ball. I don't know if the market will fall another 10 or 20% from here. Nobody does. Anyone who tells you they can perfectly predict the market's next move is either lying or fooling themselves. That is why trying to time the market perfectly is usually a fool's errand. As Benjamin Graham, Buffett's mentor, said, in the short run, the market is a voting machine, driven by popularity, sentiment, fear, and greed. But in the long run, it's a weighing machine, ultimately reflecting the underlying value and earnings power of businesses. This is why I focus on timing the market rather than timing the market. My personal long-term outlook on quality US business remains very bullish. Seeing stocks get cheaper doesn't make me want to sell. Honestly, it makes me want to research and potentially buy more of the companies I believe in the long haul. If you still believe in the fundamental strengths of the business you own or in the long-term potential of the US economy, then maybe you should view this as a chance to potentially add to your positions at a better price rather than run for the exit. Okay, now let's specifically address this tariff. Yes, they are likely to cause economic pain, both in the US and for the countries target. Trade friction isn't good for global growth. Frankly, broad tariffs like this often seem counterproductive. That's why my personal view, and it's just a view, is that they might be primarily a harsh negotiation tactic designed to bring other leaders to the table. If that's the case, they might not endure indefinitely. We could see agreements or walkbacks down the line. But even with this tariff uncertainty, let's look at the underlying US economy, ignoring the tariffs for a moment. The picture has actually been quite strong recently. We have seen solid GDP growth. There is enormous potential for productivity gains from AI in the coming years. Unemployment remains near historic lows, and inflation, while still a concern, has been trending downwards and seems to be getting under control. So, from that perspective, this roughly 10% drop in 2 days could look like an overreaction driven by fear of the unknown. But, and this is important, we don't know the immediate future. What happens next likely depends on how this tariff situation evolves. There are broadly two paths with significant possibilities. Path 1, retaliation and recession. If other countries retaliate with their own significant tariff, supply chains get disrupted further, costs rise, and we could see inflation spike again. This could force the Fed's hand and the potential tip the economy into the recession that some analysts, like those at JP Morgan, have been warning about for later this year. We can have path 2, negotiation and recovery. If negotiation happens, agreements are reached, and some of these tariffs are moderated or withdrawn, investor confidence could return quickly. Combined with the underlying economic strength, growth, controlled inflation, low unemployment, we could avoid a recession and potentially see a sharp stock market recovery, maybe even heading towards new highs. Which path will we take? It's impossible to say for sure right now, but understanding these possibilities helps frame the current situation. Ultimately, navigating volatile markets comes down to your time frame, your research, and your emotional control. Corrections and bear markets feel painful, but they are a normal part of investing, and historically, they have presented opportunities for those who keep a long-term perspective and avoid panic. So, what do you think? Are these tariffs a temporary storm or the start of something worse? How are you approaching this market right now? Let me know your thoughts in the comments below and I'll read them all. If you found this video helpful during this turbulent time, please give it a thumbs up and considering subscribe for more content on investing fundamentals, navigating the market. Stay patient, stay disciplined, and I will see you in the next video. This video is for informational purpose only and should not be considered financial advice. Always conduct your own research and consult with a qualified financial advisor before making any investment decision.